Okay. I thought that was the thing beeping for a minute. And so we're going to go ahead and complete the discussion of pass-through entities that we started with partnerships. And we're going to see that there are a lot of similarities between how we will tax partnerships as pass-through entities and how we'll treat the S corporations. Now, of course, that begs the question, well, why even go for the S corporation route then? Well, maybe we want the what? We want the liability protection that you get from a corporation. And if we meet the requirements for an S corporation, typically what an entity will do is start out as a C corporation, subchapter C, and then they'll go ahead and elect into the S corporation status. Okay, so we're going to have to meet certain requirements to do that. Always got to get the wrong clicker. It's this one. Yeah, okay, so let's just take a look at what the nature of the S corporations are, and you can see, as I've already stated, that what they are similar to partnerships in that what earnings and losses of the corporation, now the S corporation, are passed through to the shareholders. So the owners will elect to treat their corporation as a flow-through entity, and that is covered under its subchapter S. That's the reason we call them S corporations. Okay. Now, when you form the S corporation, you are first going to have to be a regular subchapter C corporation, and then when all the shareholders agree, okay, it's not by a majority vote, everyone has to agree that we're going to turn the C corporation into an S corporation, and that will result in the election that is filed on this Form 2553. Okay. Now, after the election is made, if we add shareholders after that, they do not have to approve that. Once we get into the S corporation status, we can stay there, and we don't have to keep getting, consent of new shareholders as they come along. Okay. Now you come over and take a look, and the taxability of the C corporation is, or I should say the S corporation, when we make contributions to it, is the same as what we studied for C corporation. So remember, you don't have to pay tax if the contribution is property, not services, solely in exchange for stock, and after we have made the contributions, then we have to have the 80% ownership. So same rules that we talked about for C corporations also apply to an S corporation in order to have contributions not be taxable. Okay, and so if it falls outside of these terms, then the contribution into the S corporation would be considered taxable. Then we come over and take a look at what makes a corporation eligible. First thing, it has to be a domestic corporation. Okay, there's certain allowability to incorporate inside the United States if you meet certain requirements as a foreign corporation. You can't be one, you have to be a domestic corporation. Okay, shareholders. Okay, eligible shareholder could be an individual, an estate, certain types of trust. An individual shareholder may not be a non-resident alien. Qualified retirement plans, trusts, 501c3 charitable organizations may be shareholders. Neither corporations nor partnerships can be shareholder in the S corporation. Okay, and then grantor and voting trusts are permissible shareholders. Okay, so the shareholders have to meet certain requirements. Okay, and that's really what's talked about there. Now, there is a limit. Okay, there may not be more than 100 shareholders. Okay, so it's going to be what? A small, closely held corporation that's going to be qualifying here under these circumstances as a S corporation. Okay, family members may elect to be treated as one shareholder. Okay, so you could have, 5 different people, all the same family. They're counted as one against the total of the 100. Okay, and you can see that family members include, sort of the usual suspects. Interestingly, former spouses also apply, and I think they're probably looking at there was some sort of ownership before the divorce. They don't make them give up that ownership, for qualifying for the 100 shareholders just because of a divorce. Okay, one class of stock. Okay, so no preferred stock, just one class of stock. Preferred stock is not permitted. So you can have one class of stock, probably common stock. However, differences in common stock voting rights are permissible, but one class of stock. Okay, preferred stock is not permitted. Now you look at that, and that has a potential to affect sort of startups that may want to be a closely held S corporation, and that often with startups, what happens is the early on investors want to have their investment protected, guaranteed somehow, and so they'll put a preferred liquidation status on that, or some preferred stock is such that it's actually treated like a liability. Well, that would then preclude some startups from going into the S corporation status if there cannot be preferred stock. So that's kind of an interesting twist there. For a startup corporation that you think might want to be an S corp, but they're prohibited from having. But often they rely on preferred stock to attract capital, and you're kind of being aced out of the S corp status because preferred stock is not permitted. Okay, good. So just looking at a couple things from the text here in terms of when do we have to make the election on that Form 253, and we have to make it either before the current year or we have to make it by the 3rd month of the 15th day of the current year. Okay, now let's say return to the big picture, and they have that big picture thing that goes throughout the chapters, but you don't have to go back to the big picture to figure this out, to understand this. So suppose in 2017 shareholders Smith and Jones decide to become an S corporation, and they want to have that happen beginning January 1st, 2018. Okay, because the S corporation uses a calendar year, the S election can be made anytime in 2017, or by or by January 18th of January 15th. And any election made after that is not effective until until 2019. So they give them to the 3rd month, 15th day of the current year in order to be treated as an S corporation in 2018 in that example. If they don't meet that cutoff, then they're not going to be able to be treated as an S corp until Until 2019. Or if they filed it obviously in 2017, they'd be good for 18. Okay. Now, they tell us that this 2.5 month window is going to be relevant, okay, but it's not valid unless the corporation has already qualified as an S corporation for the entire year. Otherwise, the election is not effective until the next year. Okay, so we'd have to meet the requirements for that entire year of, in that example, 2018. Otherwise, it's not going to be applicable until the next year. Now, they have the situation here where you could have the S corp, and you could have the situation where they are trying to elect S corp status before they have even formed the corporation yet. Okay, so that can't happen. Okay, certain events have to have occurred in order for them to even file as an S corporation, and there has to be any one of these. It doesn't have to be all of these. Any one of the following can be met there, and there has to be the corporation has to have shareholders. Okay, so we'll have to have shareholders, not hairholders, but shareholders. They have to have acquired some assets, or they have to have begun doing business. And any one of these would then allow you to go ahead and file to be an S corporation. Okay, so you look at this example, and we have several individuals acquire asset on behalf of Rock Corporation, June 29, 2017. Now you look at that date, and you're already thinking, okay, I think June 29, 2017 is the date because they've acquired assets, haven't they? Okay, so you keep going, though, and they begin doing business July 3rd. They subscribe to shares and file the articles of incorporation on July 7th. The S election must be filed what? No later than 2.5 months from June 29th, because they acquired assets for the corporation, so the clock started running. Okay, so it can be any one of those, doesn't have to be all of those. And that would make it effective for 2017. Now you look at that and you say, I thought you said it has to be all of 2017. Well, look, if you hadn't started business before that, they consider that to be all of 2017. But once you start business, then it would have to be the remainder of 2017 that you'd have to stay meeting the requirements in order to be considered an S corporation. Okay. All right. Take a look at a couple questions from the homework, from the quiz. Okay. And S corporation must possess which of the following characteristics? Not more than 100 shareholders. Now, be careful when you're looking at a question. Is there a question? No? Okay. Just fixing your hair? Okay, I thought you had a question. Okay. So what happens? You're sitting here and what? An S corporation must possess which of the following characteristics? Not more than 100 shareholders, yes. Has to be what? A U.S. corporation, only one class of stock, so all of the above, right, are part of what we have to meet the requirements for. Okay? Okay, good. Let's take a look at this one. Several individuals acquire assets on behalf of Skip Corporation on May 28th and begin business on June 11th. They subscribe to the shares of stock, files articles of incorporation for Skip, and become shareholders officially on June 21st. The S selection must be filed no later than 2.5 months after what? May 28th, because we had met one of those requirements. We had started to acquire assets on behalf of the corporation, right? Okay. All right, good. So that's sort of dealing with formation. Oh, we did this one already? No. The maximum number of actual shareholders in an S corporation is indeterminable. Okay, the actual number, because what? Family members count as one, right? So, I mean, if you have a huge family of, 500 people or something stupid like that, I don't know if you could have a family that big, but if you have a family that's a large family, then you could be exceeding the 100, right? Because they're counted as one shareholder. Okay? All right, good. So let's take a look at operation, okay, of the S Corp. And it is very, very similar to the operation of a partnership in that what? Each year the S corporation will determine non-separately stated income or loss and what? Separate income items, okay? Just like we did for the partnerships, right? Okay. Now, these items are taxed only once at the shareholder level. So again, the non-separate and the separate items get pushed down to the shareholders, and they are taxed at the shareholder level. So all items are allocated to each shareholder based on, and this part's a little bit different because when we looked at it for partnerships as to who gets what, remember there was those percentages of the partnership that's owned, and there were discussions as to how things get distributed, and it was in the partnership agreement and so on and so forth. Well, this is something, I put stars on this because this is a little different. For S corporations, we do what? We look at the average number of days that they held certain percentages, and that is how we determine what gets allocated to those. And you'll see when you look at that, it's actually pretty easy, kind of fun to calculate those. In fact, rather than watch the basketball game, have your friends over and calculate a few, these percentages. It's kind of fun to figure out the average number of days. Okay? All right, so you come over and we say on the next slide here, an S corporation's taxable income or loss is determined in a manner similar to the tax rules. We already said that. They would apply to partnerships, so we're sort of repeating ourselves here, okay? And then what? The dividends received deduction, however, is not available to S corporations. So that's something that was limited to what? C corps, where we did the dividend received deduction, okay? All right, come over and let's take a look at the next slide and non-separate items. Okay, these are things that are going to be calculated at the corporate level. Constitute the subchapter S ordinary income or loss. Okay. Then the S corporation will have separately stated items that are identical to those separately stated items that we already studied in Chapter 21 for partnerships. Okay, these items retain their tax attributes on the shareholders' return. In other words, remember the classic example was charitable contributions get passed down as separable items to each of the partners / in this case now shareholders, and whatever the limitations are on what that shareholder can take as charitable contributions using the 20% and the 50% test that you all love so much, that will be applied at the shareholder level. Okay, then separately listed items are listed on Schedule K of the 1120, and notice the tax return form is 1120, which is the same as we use, the same numbers that we use for C corps, but now we do what? We add the S to that because it's an S corporation and report those separable items on Schedule K. Okay, so not an exhaustive list, but example of separate items, and you can see that these are very similar to what we did for partnerships, tax exempt income, like they have some sort of, state and local interest that's paid to them, gains and losses from disposal of business property and capital assets, charitable contributions, income loss from rental of real estate, interest, dividends, royalty income, okay, etc. These things are going to be treated as separately stated items. And so those will be pushed down to the shareholders on their Schedule Ks, as well as what? Any proportionate share of the corporation's ordinary income based on that average days. And you'll see how those calculations work here in a second. Okay. So this is a nice graphic from the text here that I left in from the text slides. That I don't know why they have to put that corporate veil there. It's kind of stupid, but you take a look and you have the ordinary income, which is going to then be reduced by trade or business expenses. If there's any depreciation recapture, which we didn't really study that too much in here, but depreciation, I don't think at all. Depreciation recapture is if you've taken deductions for depreciation on an asset, and then you turn around later on and you sell that asset, they're going to make you recapture that depreciation. They're not going to let you write the basis of the asset down on depreciation and then what? Take the tax benefit. Tax benefit rule starts to kick in. Hey, you already took the deduction for tax purposes. We're not going to also let you reduce the basis of that property under the tax benefit rule. And so there would be a requirement that you recapture any depreciation that was taken. Okay. All right. Good. Did everybody sign this? Okay. You have to just put your date next to today's date next to your name. Okay. Okay. Good. But you can see that all those other things that we saw listed on the other slide, they get passed down as separable items. Okay. Okay. Good. Can you take a look? And you have this, and don't worry about the example number. Borrowed this from another piece of information I had. Okay, so facts are that Gray Corporation, S Corporation, has the following items of income and deductions for the year. Calculate Gray's corporation's ordinary income and separately stated items. So the ordinary income is what? Is the gross income less what? Less our cost of goods sold, and then just sort of normal business deductions here, such as our, our salaries and depreciation, right? Okay. Separately stated items include some of those things that we saw on the slide that were relevant to this question. Section 1231 gain is the short-term, long-term gains that we talked about before. You may not remember the section. And then what? Charitable contributions. All of those things were treated separately. Everybody sign? Yeah? Okay. Okay, good. Now you come over and take a look at the example from the textbook. Now they took a little bit of a different approach here, and that they first figured out the income, the net income per books. Okay, now you probably remember from intermediate, we call this a multiple step income statement. Maybe you remember that from 102A, I don't know, multiple step income statement. And that we do what? In a multiple step income statement, we put our operating items separate from items that are considered what? Non-operating, okay, in the calculation of our book net income. Now, if you want to get the ordinary income, and notice, guys, this is ordinary income at the S corporation level, you are going to do what? You are going to basically put back those items that would have been treated like a maybe either non-operating, or in the case of charitable contribution is treated as operating, but nonetheless you're going to go ahead and put what? Put back the things that are separable to come up with the ordinary income for the corporation. So there's the tax-exempt interest, we add that back. The dividend income, we add that back to our net income. The long-term capital gain, not add it back, but we take those out because those are what? Separable items, right? So we're taking them off of our book net income. And then we add back the charitable contribution because we subtracted that off of calculating our book net income. We put back what? We put back the short-term capital loss because that's going to be a separable item. Okay, so after you back out the effect on net income of the separable items, then you come up to what the corporation's ordinary income is. Okay, that's all they did there. They just backed out the effects either by what? By subtracting income items that are treated separately, or doing what? Adding back expense items that should be treated separately at the corporate level to come up with the ordinary income. Okay. Okay, so now we have these allocation of income and losses, okay? And it's going to be based on the pro rata share that each individual is going to be entitled to based on their share of the ownership, okay? And so it's a pro rata share of each item for each day. It's at the day level that the stock is owned. So we get down into a pretty detailed calculation of how we're going to distribute these. And for some reason now I get to be locked up. Isn't that beautiful? Okay. So we are going to not discard this. We're going to not... Every time we gotta have something. Wouldn't be complete if we didn't have a technical difficulty in the middle of this thing. Okay, all right, so let's just go ahead and take a look at how we'll do this. So we'll take whatever the item is that we're trying to distribute. We'll take that times the percentage of shares owned times the percentage of the year the shares are owned, and that's the amount that will be reported to that particular shareholder. Okay, so you come down and you look at this Pat, a shareholder, owned 10% of Jersey stock for 100 days, and 12% for the remaining 265 days of the tax year, and they say it's not a leap year, okay. And using the required per day allocation method, how will we calculate Pat's share? So first there's that non-separable ordinary income of the S corporation that's going to be allocated to Pat. And so Pat had what? For the 10% allocation, that was what? That was 100 out of the 365 days. And then for the 12, that's how we got this 337. Okay. And then what? For the 12% allocation, that was going to be the remaining part of the year that Pat had 12%. And so you do that calculation, that's going to give you what? That's going to give you the 1072. You add those two together, that gives you the 1409 that gets allocated to Pat using just the days allocation, assuming 365 days in a year. I guess if it's a leap year, then it'd be 364, I guess. I don't know. Okay? Or whatever, 6, whatever it comes to. Okay? Okay, good. Let's go ahead and let's take a look at now the distributions. Okay, now there's two different ways that distributions are looked at or how they are taxed depending on whether there were earnings that were basically accumulated while the corporation was in C Corp status. If there are no earnings, then it's simply whatever's been earned while we're in S corporation status is what we're going to determine to see if there's going to be a tax consequence to any distributions. If we have earnings that were already accumulated when we were in C Corp status, then we're going to have to consider those in determining if there's any taxable consequence to distributions. Okay, so you come over and when we have a distribution, it's obviously any cash plus the fair market value if we had a property distribution. Okay, and again, as we said, it depends whether or not there have been accumulated earnings and profit from the C Corp years. Okay, and we're going to abbreviate that AEP. Okay, now the easier case is if we are sitting here and there were no earnings during the C Corp years, then it is non-taxable to the extent of the adjusted basis in stock. If there's any excess that's distributed, then that's treated as a what? As a distribution of earnings on the investment, and that will be taxed. Okay, so we take a look at Twirl Inc., a calendar year S corporation, and there were no accumulated earnings and profits from C Corp years. During the year, Juan, an individual shareholder of the corporation, receives a cash distribution of $12,000 from Twirl. Juan's basis in the stock is $9,700. Now you say, how do we come up with the basis in the stock? Well, if we put in cash into the corporation, it was the cash that was put in. If we brought in property, it was his basis of whatever the property was, etc. We talked about the rules being like they are for partnerships and, or I should say, C corporations when we make investment into the corporation. Okay, so that was his basis, $9,700. And so there's going to be what? A capital gain tax of $2,500 because he received a distribution in excess of the basis in the stock that he had in the S Corp. Okay. Now the remaining $9,700 is tax-free, and now the basis of the stock is down to 0, right? Okay. Now you take a look at the next slide, and what happens if there are earnings from the C Corp years? How should we handle that? Well, we're going to have to calculate something called an accumulated adjustment account, an AAA, and distribution of the accumulated earnings and profits are going to be taxed as dividends, while distribution of previously taxed X corporation earnings are tax-free to the extent of the shareholders' basis in the stock. That will bring the AAA to 0 at the inception of the corporation. Increases to AAAs essentially increased by separately and non-separately stated income items and gains that have been distributed or been allocated. I should use the word distributed, but allocated using that formula that we talked about earlier to that particular shareholder. Decreases to the AAA is essentially any distributions, however, were capped at 0. We're capped at 0. Now I'm going to show you 2 examples, and the reason I'm showing you the 2 examples, the one example is probably, the second one is probably the better of the 2 examples. The problem that I have with example number 2 is it keeps that AAA static, and so you lose the point that the AAA is actually moving from year to year as we have as we have amounts that have been earned by the S Corp, as we have withdrawals, etc. Okay, so you kind of have to take the 2 examples together here to get a full picture. So let's just look at this first one. The New Elect Corporation was a C corporation until it elected S status on January 1st, year 2. New Elect accumulated earnings and profits of $20,000 at December 31st, year 1. So we have accumulated EMP, right? Then what? For the prior year, I should say for the period year 2 to year 8, New Elect had ordinary income of 100 and made distributions to shareholder of 60. Thus, New Elect's AAA is going to be what? It's going to be 40,000. It's that first year as an S corporation, right? The 100,000 minus the 40 brings that balance up to 60,000. In year 9, it had ordinary income of 40,000 and made distributions to shareholders of 110. So we started with what? We started with 40 at the start of year 9. We earned another what? We earned another 40 in year 9. So now the AAA is what? 80,000, and those amounts had already been distributed to the shareholders. They've already paid taxes as shareholders on those. So that distribution of the 110 is tax-free, right? Then what? Then we go, and the next 20,000 is going to be treated as a dividend, because they're looking at that as what? As a distribution, as a dividend from the C Corp years, right? And then once that is wiped out, then we go ahead and any excess is going to reduce the basis in the stock. Okay, they're basically saying, hey, they're cashing you out essentially. Okay, now that example goes through the pecking order that you're supposed to use these amounts as they get distributed. And the next example, I think, is a little better, showing you how the amounts are distributed, but it doesn't have the AAA changing over a couple year period where we have 0 to begin, then we have what? Then we have a certain amount that adds in year 1, that carries forward to year 2, more earnings, and then we start taking the distributions out accordingly, and we use up whatever's in that AAA first. Okay, but the AAA would move like that over the course of time, over a period of time. Now in this example, they just have the AAA staying at this 500. Okay, so short a calendar year, S Corporation distributes $1,300 cash to its only shareholder, Otis, on December 31st. Otis' basis in the stock is $1,400. Short's AAA balance is what? 500. And it's just going to stay at 500. We saw that we got to whatever the number was, 80,000 in that other example over the course of a couple years, whatever, right? Okay, but here the AAA is just this 500,000, and short holds a 750,000 AEP, accumulated earnings and profit, from the C Corp years before they turned to the S Corp election. Okay, according to distribution rules, the first 500 go against the AAA, don't they? Just like we saw in the last problem. Okay, the next what? The next 750 go and are treated as a dividend, and it wipes out the accumulated earnings and profit from the C Corp years, right? So now that's zeroed out, and then what? The remaining and 500 that we've already taken for the AAA portion, that goes against the basis of the stock. And then there's still what? There's still this $50 left over. That goes against the basis of the stock now. So now the stock has a basis of $850, right? Okay. Now they tell us that in the next year, if Otis sells the stock for $1,000, then what? Up to $850, the basis of the stock is tax-free. Any remaining amounts then would be taxed, and it's probably taxed as a capital gain. Question? Okay. All right. So those two questions taken together, the only reason I had that other example up there because I wanted an example in which the AAA moved over a couple-year period. It doesn't just stay, it's 500 and it's always 500 and it just doesn't stay there. It'll move as you go year to year, right? Okay. Okay, good. Now you come over and you've got a potentially short class here today, guys, but let's take a look at a couple of these questions, okay, because I think we got 3 or 4 questions and that's it, okay, but let's just take a look at a couple of questions here. When item is not included in an S corporation, which item, I should say, is not included in S corporation non-separately computed income, okay? Net sales minus cost of goods sold, the gross profit, that is part of the separate calculated, non-separately calculated items, right? Dividends received, no, dividend received is dividend income, isn't it? Okay, and that's going to be treated separately. The depreciation recapture we talked about is part of the what? Non-separately calculated items, okay? So a good way to look at this is just sort of normal operating type items tend to be treated as what? As separately computed items. And then sort of your non-operating items are typically tend to be the separately computed ones. Okay? Although charitable contributions, they treat it as an operating item in that example we had. Okay. Which item has no effect on S corporations? AAA. Okay. Stock purchased by shareholders is the obvious answer here. But just look at these other ones. Interest expense is going to be what? Treated as an operating expense. It's going to be part of calculating the S corporation's ordinary income, isn't it? Okay. Cost of goods sold is used in calculating the operating income. Capital loss, and you sit there and say, well, wait a minute, John, isn't that a separable item? Yes, it is, but in terms of calculating the AAA, we have what? Any amounts that were distributed to the shareholders are going to be part of that AAA, and so capital loss would have been distributed as a separable item, but is still going to affect the calculation of the AAA. Okay? Okay, good. Let's take a look at this one, and this is a tricky question. Very tricky, I thought, because I looked at it a couple times and I was like, oh, I see what they did. But it's pretty tricky in that they are talking about Oxen Corporation up here, right? But then they get down and they ask you as what is Megan's effect? And Megan is the shareholder. So you get confused, or I got confused when I first looked at this, because I'm sitting there and I'm saying, why are they calling that ordinary income, including the interest as ordinary income? Well, they're correct. I would be correct that it's not ordinary income if they were asking me about Oxen's ordinary income, which is the what? Which is the S Corp. When we get down to Megan's level, she's going to treat interest from a savings account as what? As ordinary income, isn't she? Okay, so her share of the income from operations, okay, plus interest from the savings account, which gets distributed down to her as a shareholder level, are both what? Ordinary income, right? These other two are not ordinary income because they fall under the short-term, long-term capital gain rules that we studied for individuals, right? And those are not treated as ordinary income. They had special rules and rates and stuff that applied there, right? Okay, so for Megan, the ordinary income is, the answer here is C. The ordinary income includes the interest, right? And the long-term and short-term capital gains and losses are not considered ordinary. Okay, if they ask me for oxen, the answer is what? 100,000, right? They didn't ask me for oxen, though. Okay. Question? Oh, is there one more? Oh, yeah, one more, and then we'll see if we're going to get out of here. Okay. This one is just sitting here and giving you the allocation. Okay, so we've got entity incurs 60,000 loss. On the 200th day of the year, Bobby sells 1/2 of the stock to his son Saul, whatever. Okay. I used to have a buddy who spelled his name like that, but he called himself Saul. Okay. He's no longer with us. He died at a young age. It's pretty sad. But anyway, so how much of the 60,000 loss, if any, is going to be allocated to Bobby? So Bobby is the dad or the kid? Who's Bobby? Bobby sells 1/2 of the stock to his son Saul. How much of the 60,000 loss, if any, is allocated to Bobby? And so what happened? Bobby held the stock for 200 days, right? Okay. And so it's going to be 200 out of the 365. And since he sold what? He only sold 1/2 of the stock, then it's only 1/2 of the 60,000 that would be attributed to the 200-day limitation, right? The 200-day amount that he held the stock. Okay. Question? That's all I got. Okay. Just a short look at S corporations. We don't need to go on much beyond that. Okay. So we'll go ahead and get out a little bit early this time. Next time we will sit here and we will go through a practice quiz on Tuesday. That is, as I said at the beginning of class, that's optional. If you don't want to come next time, you don't have to. Same thing with Thursday. So we'll probably have about, I'm thinking about probably a full exam. Are we still sticking with the 15 questions or not? Abby? Yeah, that's why I wanted to try to break it into two. Maybe I do two 15 questions exams, because by my calculation, it's what? Let's look at the syllabus just so we don't.
6 chapters.
It's 6 chapters? Let's look at that real quick since we got a little time. Hang on a sec. Let me get out of this. See if I can find it. Berkeley, 821. Okay, guys, so if you take a look at the syllabus here, we've got, where are we at? We've got, we put chapter 10 on the last midterm, right? So we've got chapter 11, 12, 17, 18, 21, 22. Somebody said 6 chapters. So we've got 2 more chapters than, we typically have had up until now. Now, I'm thinking, from my standpoint, I'm going to spend less time, less questions on the exam with chapter 11, 12. I'm probably going to go a little heavier, 17 and 18, a little lighter, 21 and 22. Okay, since 17 and 18 are sort of the core things about corporate. And if you look at like the CPA exam and stuff like that, that's where they tend to focus more of their attention is on corporations, not so much on the flow-through entities. But I'll have some questions from all of these. So what I'm trying to gauge here is, since we have, what, like 3 hours, is it to your advantage to have more questions is what I'm asking. I don't care. How many want more questions than we've had in the past? 1, 2, 3, 4, 5, 6, 7, 8. Yeah. Great. Split it 50-50, just so I have the opportunity to piss everybody off. Okay? All right. So with that, we'll go ahead and we'll just not change. I mean, if I'm going to get a 50-50 split, I just won't change. I'll tell you what I'll do. I'll put a poll on... I can put a poll on B courses. You can vote there, okay? And probably it'll be split right down the middle so that I have to make the decision as to what it is we want to do.
What about previous chapters? You said you might include 1 or 2 previous chapters.
Yeah, you know, I don't know. I mean, I guess I could justify the more points. The reason I was talking about doing that, Alice, is because I was looking at the fact, where's my point distribution? There it is. You keep going back past it. Because we've got more of the grade being comprised of the final exam relative to the other tests. So, I mean, that would nudge me towards maybe giving more questions on the final, right?
Yeah, more questions. With 3 hours.
Huh?
What if we do more questions, but since it already talks about capital gains,
Yeah, I'm not going to go nuts on them previous chapters. I mean, it would be like really, really easy stuff, like, you know, the I in IRS stands for internal or something stupid like that. Okay.
Still open notes?
Yeah, everything, yeah, still open notes, open, whatever. Just don't come in here with the test bank printed out, you know. Is the only thing I don't want you to do. But other than that, you can come in with stuff. Oh, did I say that? Okay. Okay. So I'll put questions from the previous chapters that are, and again, 1 or 2 that are from the previous midterms. You want to do it like that? Okay. And that will justify the cumulative impact. How much has it been in the past? Like 10 points? It's probably 10 points. What do you want it to be? I don't care. I don't care. I can make it 10% or 10 points. I don't care. I don't want to make it less than that. Otherwise, what's the point? No point. No pun intended. It almost becomes a multiple choice question. Then, huh? I'm thinking all or nothing. Partial credit becomes so subjective, guys, as to what we give for partial credit and don't, that I don't like to do that. Because then I've got 50 cases as to why somebody should have gotten some points like that. So it's going to be all right or all wrong. You know, there might be a couple numbers I have you calculate, but those couple of numbers are going to be either right or wrong. Okay, so we got a couple of elements here to consider. I think where we're headed is this. The final exam will be cumulative in that I will include questions that were on previous midterms. Yes? Yes. Okay, so I'll give you a couple questions that have been on previous midterms. That'll make it cumulative. How many questions is the next thing? More questions, I'm thinking, is where we're headed. So we'll make it 20 instead of 15. And then we'll make it a free response question. Just one free response question. And for the free response question, you want it to be worth 10 points or 20? 10. Okay. Sold. Okay, so that's how we're going to do it. We're going to do 20 multiple choice questions. There'll be, and I'll just tell you now, there'll be 5 from previous exams. 5 from previous exams of the multiple choice. There'll be 15 new questions from the new material. And then there'll be a free response that will be worth 10 points from the new material. 15 new. What do we got? 6 chapters. Okay, so I'm thinking from out of the 15, probably 5 from chapter, probably 10 from chapter 17 and 18. 10 from chapter 17 and 18, and the remaining 5 questions will come from probably, like maybe 2 each, although that's 8, but somewhere in that range. 1 each for sure, and maybe 2 from one or the other.
Will free response be more towards 17, 18?
Yeah, more 10 questions from 17, 18, and the remaining 5 sort of scattered amongst the other chapters.
And then free response also 17, 18?
Yeah, free response 17, 18, which actually means maybe I'll do a little more from those other ones, 1 or 2 from those other ones. Okay, but the emphasis is what? Clearly chapter 17 and 18. I mean, you should walk in here sort of on fire with things that we talked about from 17, 18. And that shouldn't be shocking because the chapter 21 and chapter 2, 22, look at how quickly we got through it. So you got 3 hours on 510, right? 3 to 6 p.m., nighttime. You'll have the whole class period. All right. Okay, guys, I will see you on Tuesday. Be looking for a couple, if not one big practice midterm, and we'll cover it over the next few days, all right?